Welcome to another explainer. Today, we're diving into our market intelligence systems to decode a massive macro tremor that hit on August 18, 2026. If you've been watching the markets lately, things have felt pretty chill, right? A classic Goldilocks environment. Growth is steady, inflation is cooling down. It feels like everything is just right. But beneath that perfectly calm surface, our diagnostic tools just caught a severe anomaly. And honestly, it demands immediate attention.
Let's look at this exact data point, an 8.7% overnight spike. Now, in the financial world, a violent 8.7% jump in a single night? That is not just background noise. That's a blaring siren. It tells us that something fundamental just shifted while the rest of the market was literally asleep. We've got to figure out exactly what this means for your portfolio before the crowd catches on.
So to really grasp the severity here, we need to talk about the MOVE Index. Think of it as the ultimate pulse monitor for uncertainty in the fixed income market. Now, I'm sure you're familiar with the VIX, right? The fear gauge for stocks? Well, the MOVE Index is basically the VIX for bonds. It tracks how violently traders expect interest rates to swing. When the MOVE Index spikes like this, it means bond traders are frantically pricing in massive uncertainty, whether that's about the Federal Reserve, inflation, or just underlying liquidity stress. It is our ultimate early warning system.
And here's exactly what that looked like. At 03 UTC, our systems caught this anomaly, forcing our macro regime classification right out of a cooling phase and straight into an amber watch zone. We were cruising along in this low volatility regime and then, boom, it's kind of like driving down a perfectly smooth highway and suddenly slamming into a massive pothole. You instantly grip the steering wheel a little tighter and start scanning the horizon for more trouble.
All right, let's run a full institutional-grade diagnostic protocol on this. We'll start with the system alert for the volatility flare, move into the Fed's fractured consensus, track the 72-hour transmission window, and finally lock in on our tactical protocol for quality tech.
So, step 1 of the diagnostic, system alert volatility flare. Let's isolate this high-velocity anomaly.
The crucial thing to understand here is that this wasn't just your standard market drift. No way. This was a concentrated shock that triggered our most extreme velocity alerts, what we call condition C. This condition only activates when we see an intraday spike of 8% or more compressed into just a 4-hour window. Think about that. When dealers are forced to aggressively hedge all at once in such a tiny time frame, it creates a sudden vacuum of liquidity. This kind of rapid velocity, it's the absolute hallmark of unexpected panic, not some slow, gradual shift in sentiment.
Looking at the historical context here, a jump this sharp demands we investigate right now. Sudden spikes in the MOVE Index rarely just happen in a vacuum, you know? They often act as the leading edge of a much broader regime change. So, our job today is to figure out, is this just an isolated tremor that's going to retrace, or is this the first domino falling in a massive chain reaction across global markets?
Let's move to step 2, the Fed's fractured consensus. We need to diagnose the root cause.
The data points squarely at the central bank. A 9-3 internal dissent vote at the Federal Reserve is highly unusual. The market absolutely loves a unified, completely predictable central bank. So when you suddenly have 3 dissenting voices at the highest level of monetary policy, that signals a seriously fractured consensus. The market just woke up to the fact that the path forward for interest rates is definitely not guaranteed, and that abrupt, scary uncertainty is exactly what caused the MOVE Index to explode overnight.
To really map the damage, let's compare the hypersensitive 2-year Treasury yield against the much more stable 10-year yield. The 2-year is essentially a real-time tracker of what traders think the Fed will do next, and it is going completely haywire right now. Meanwhile, the 10-year yield? It's remaining stubbornly disconnected, resting near 10-year highs and anchored by what's called term premium, which is basically just the extra compensation investors demand for holding longer-term debt. This dynamic is super important because it proves this crisis is purely a front-end policy panic. We aren't seeing a fundamental reassessment of the entire global economy here.
Okay, step 3, the 72-hour transmission window. Let's calculate the blast radius. Because what happens in the bond market almost never stays in the bond market, the clock is officially ticking. Historically, a MOVE spike is a leading indicator. Within the first 24 hours, we typically see the VIX, equity volatility, start to twitch. By 48 hours, the actual stock indices start to reprice. And the ultimate test comes right around the 72-hour mark, where we watch high-yield credit spreads. If credit spreads blow out on day 3, well, that means the initial rate shock has officially mutated into a full-blown liquidity crisis.
So let's look at our live diagnostic sweep and run through our cross-asset checklist. Right now, the VIX is deceptively calm, although we're noticing deep out-of-the-money downside hedges quietly being accumulated.
This checklist right here is basically your ultimate survival guide. We don't guess, we measure. We are closely watching equities, credit, and foreign exchange. But the true canary in the coal mine is credit, specifically high yield or HYG. If HYG stays stable, this whole event is just isolated noise. But if the US dollar strengthens sharply while credit sells off, that is a definitive bearish signal that global liquidity is draining from the system.
Visually assessing our current stress levels, you can see credit liquidity is holding the line. There's literally zero panic in the corporate bond market today. However, take a look at that firming US dollar. The dollar index, the DXY, is firming up into our amber zone. A stronger dollar combined with a MOVE index spike is a classic footprint of international capital fleeing to safety, which tends to tighten global liquidity at the margins. Look, it's not a red alert just yet, but it is absolutely a reason to check your blind spots.
Bringing us to our final step, Section 4. Tactical Protocol, Quality Tech. Let's output the action roadmap.
So, with the threat mapped out, how do we actually position our assets? Well, because the system categorizes this as an amber watch rather than a full red alert, our protocol dictates a highly specific rotation away from front-end uncertainty and into quality. We aren't selling everything and hiding in cash. Instead, we want to scale out of sectors that get crushed by rate volatility, like real estate and high-beta cyclicals that swing wildly with the broader economy. And we want to rotate into quality large-cap tech. These mega-cap tech companies act like long-duration assets with massive cash moats, making them surprisingly resilient to all this short-term Fed noise. And lastly, we maintain our energy exposure, because ongoing geopolitical friction, specifically risks around the Strait of Hormuz, provides a really vital hedge against any secondary inflation shocks.
Returning to our primary dashboard, embed this narrative into your strategy. We are dealing with a localized tremor. Liquidity is currently totally intact. This is not a systemic collapse, guys. It is simply a cooling macro regime that got punctured by a short-end volatility flare. The plumbing of the financial system is still working completely fine. Dealers are just scrambling to reprice the odds of what a suddenly divided Federal Reserve might do next month. So yes, it absolutely requires a defensive tilt, but for sure, not absolute panic.
I'm going to leave you with this final systemic diagnostic query. You have the intelligence now. You know the 72-hour window is currently wide open. If credit holds steady today, and this really does prove to be an isolated rate tremor, the window to optimize your positioning into quality tech is happening right now. So the question is, are you ready to make your move? Thanks for joining me on this explainer, and as always, keep your eyes on that data.